Your savings account says $4,000. You put it there. You were responsible. You did what every financial expert told you to do: keep 3 to 6 months of expenses in an emergency fund. Liquid, accessible, safe. But here is the thing nobody told you. While your $4,000 sat in that account doing what it was told, your bank took that same money, lent it out at 8, 12, sometimes 20% interest, and kept the difference. You did the saving. They collected the income. So who exactly is this emergency fund FOR? Think about the last time you checked your savings account interest rate. If your bank is giving you anything, above 0.5%, you are doing better than most people. The national average savings rate right now sits around 0.46%. That means on $5,000 sitting in your emergency fund for a full year, you earned $23. $23. You gave up dinners out for $23. Meanwhile, inflation ran at somewhere between 3 and 4% last year, which means your $5,000 lost somewhere between $150 and $200 in real purchasing power. You did not break even. You went backward, and you followed the advice perfectly. You did not spend it. You did not touch it. You kept it liquid just like they said. The advice to keep an emergency fund is not wrong. You should have one. The problem is not the emergency fund. The problem is where they told you to keep it and why they told you to keep it there. Because the bank that pays you 0.46% on your deposit, that same bank is offering personal loans at 18%, credit cards at 24%, buy now pay later schemes at 30%. They borrow from you at 0.46. They lend to others at 18. And the entire system is built on that gap, with your money as the raw material. Here is something most people never learn about how banks actually work. When you deposit money in a bank, you are not storing it. You are lending it. Legally, the moment your money enters that account, it belongs to the bank. You become an unsecured creditor. This is not a conspiracy. This is written into banking law. It is called fractional reserve banking. The bank keeps a small fraction of your deposit, historically around 10%, and in many cases now even less, and lends out the rest, multiple times over. So your $5,000 emergency fund, the bank might be using 4,500 of it right now to generate interest income, and they are paying you $23 a year for the privilege. In the 1930s, after the Great Depression, the U.S. government created the FDIC, the Federal Deposit Insurance Corporation, which insured bank deposits up to a certain amount. The intention was to restore public trust in banks after mass bank runs wiped out ordinary people's savings. Good intention. But here is what it actually did. It made people comfortable leaving large amounts of money sitting in low-yield accounts because they felt protected. The insurance removed the urgency to question whether the bank was actually serving their interests. Confidence was restored. Deposits flowed back in. Banks had their cheap capital again. And the advice, keep 3 to 6 months in a savings account, keep it liquid, keep it safe, became the standard that every financial planner, every budgeting app, every personal finance influencer has repeated ever since. Not because it maximizes your outcome, because it maximizes theirs. Most people think of inflation as prices going up. But inflation is also a measurement problem. Because the official number, the CPI, the Consumer Price Index, does not fully capture what working-class households actually spend money on: housing costs, childcare, healthcare, insurance. These categories have inflated far faster than the official number suggests. Here is a concrete example. In 2020, the average American had around $3,000 saved in liquid accounts. By 2024, that same $3,000 had lost roughly 15 to 20% of its purchasing power, depending on where you live and what you spend money on. You saved $3,000. It now buys what 2,500 bought 4 years ago. The money did not move. The ground moved underneath it. The banks know this. The financial advisors know this. And yet the advice stays the same. Why? Because there is an entire industry built around keeping your money in instruments that benefit the institution more than they benefit you. High street banks do not make money on high-yield savings. They make money on the spread, the difference between what they pay you and what they charge borrowers. Think about what a mortgage actually costs. You borrow $300,000 to buy a home. Over 30 years at a 6% interest rate, you pay back somewhere around $650,000. You paid for the house twice. The bank did not build anything, did not create anything. They simply sat between you and the thing you needed and extracted $350,000 for the access. That is not finance. That is a toll. And your emergency fund sitting at 0.46% is on the other side of that same equation. You are the cheap capital. They are the expensive lender. The whole system is designed to keep you permanently on the wrong side of the interest rate gap. High-yield savings accounts, the ones that actually pay 3, 4, sometimes 5%, have existed for decades. But most banks do not advertise them to walk-in customers. They are not what the teller mentions when you open an account. They are not the default, because the default account is more profitable for the bank. You have to ask. You have to search. You have to know the question exists before you can ask it. And the entire design of the standard banking experience is built to make sure most people never ask. The product they offer you by default is the product that benefits them most, not the product that benefits you most. And they are counting on you not knowing the difference. Every time someone tells you where to put your money, ask one question. Who benefits from this arrangement? Not who says they benefit. Who actually benefits when you follow this advice at scale? Because advice that gets repeated for decades across every financial platform, every bank brochure, every school curriculum, that advice did not survive because it is optimal for you. It survived because it is optimal for the institutions that repeat it. You are not bad at money. You were given instructions written by the people who profit when you follow them. That is not a personal failure. That is a design feature. And the first step out of it is exactly what you just did, understanding how the machine actually runs. It is not just about where you store money. It is about who controls the rules around how money moves. Who decides what gets taxed and what does not? Who gets access to the instruments that actually build wealth, and who gets sold the instruments that only look like wealth? That conversation is one worth having.